Imagine this: every dollar you save today is actually losing value. Yes, your hard-earned money is quietly slipping away right there in your bank account. But it doesn't have to be this way. In today's video, we're going to uncover 5 powerful strategies to not only protect your savings but to grow them, even in a world where prices seem to be rising every day. Whether you're worried about your savings shrinking, looking for safer ways to invest, or simply wanting to make the smartest financial moves for 2024, this video is packed with practical, effective tips that can help. So, let's jump in and turn inflation from a threat into an opportunity. What is inflation? Alright, before we jump into the strategies, let's quickly break down what inflation actually is and why it matters. Simply put, inflation is the increase in the cost of goods and services over time. For example, if you paid $2 for a gallon of milk last year, but it costs $2.10 this year, that's inflation in action. Prices go up, and the purchasing power of each dollar goes down. Think of it like this: if inflation is at 5% and you have $1,000 saved, then next year, you'll need $1,050 just to maintain the same buying power. But here's the problem: most traditional savings accounts are only giving you around 0.5% interest, so your money is actually losing value over time. Alright, enough doom and gloom. Let's get into some practical ways to keep your savings growing faster than inflation. Tip number 1. First up, we have high-yield savings accounts and certificates of deposit, or CDs. Now, a high-yield savings account is just like a regular savings account, but with one big difference: it offers a higher interest rate, often around 4% or more. So, let's say you put $10,000 into a high-yield savings account with a 4% annual interest rate. At the end of the year, you'd have $10,400. Not bad, right? That's a lot better than traditional accounts, which might only give you $10,050. Now, CDs can also be a good option. They're like high-yield savings, but you agree to lock your money away for a specific term, like 6 months, 1 year, or 5 years. Typically, the longer you lock it in, the higher the rate you'll get. Just be careful, because with CDs, you can't touch your money until the term is up without facing penalties. Tip number 2, diversify with stock market investments. Alright, now let's talk about the stock market. While stocks come with more risk, they've historically outpaced inflation over the long term. On average, the stock market has returned about 7 to 10% per year, which is well above the inflation rate. For example, let's say you invested $10,000 in a diversified stock portfolio 5 years ago, and the market returned an average of 8% per year. Today, your investment would be worth around $14,700. That's way more than what you'd get from a savings account or even a high-yield CD. If you're new to the stock market, one of the easiest ways to get started is with index funds or ETFs. These funds are collections of stocks that track a specific index. By investing in an index fund, you're essentially buying a small piece of hundreds of companies, which helps spread out risk. Another good strategy for beginners is dollar-cost averaging, which means you invest a fixed amount of money regularly, regardless of the market's ups and downs. Tip number 3, real estate and REITs. Real estate can be a great hedge against inflation because property values and rents often rise with inflation. But, of course, buying a property requires a lot of upfront capital and involves maintenance costs. That's where REITs come in. Real Estate Investment Trust is a way to invest in real estate without buying physical property. Think of it like a mutual fund for real estate, which can provide a steady income stream and a hedge against inflation. REITs can be a great option if you're looking for passive income and don't want the hassle of managing a rental property. Just remember that, like stocks, REITs can fluctuate in value. Tip number 4, inflation-protected bonds. These are government bonds that are designed to keep up with inflation. Here's how they work: the value of TIPS adjusts with the inflation rate, so they're a safe and stable investment option. For instance, if you bought $1,000 worth of TIPS and inflation increased by 3%, your investment's value would increase to $1,030. Plus, you'd receive interest on the adjusted amount. TIPS can be a smart addition to your portfolio if you want a safe investment that directly protects against inflation. They're not huge moneymakers, but they offer stability and peace of mind. Tip number 5, let's talk about commodities and precious metals like gold and silver. People often turn to these assets during high inflation because they tend to hold their value when the dollar loses purchasing power. For example, during times of high inflation, gold prices tend to rise. If you had invested $1,000 in gold before a major inflation surge, that $1,000 could be worth significantly more today. However, keep in mind that while precious metals can be a hedge, they don't generate income and can be volatile. If you're looking for an inflation hedge, you could consider dedicating a small portion of your portfolio to commodities or metals. Bonus tip: invest in yourself. Alright, here's that bonus tip I promised: invest in yourself. One of the best ways to beat inflation is to increase your earning potential. Building new skills or gaining certifications can open doors to higher paying jobs, promotions, or even side businesses. For example, learning data analysis, digital marketing, or even personal finance skills can set you up for better opportunities. Not only can these skills help you earn more, but they can also give you more control over your financial future. Remember, no one can take away the skills and knowledge you gain. And unlike the stock market, investing in yourself can offer returns that last a lifetime. Conclusion: alright, let's recap those 5 strategies to beat inflation and grow your wealth in 2024. High-yield savings accounts and CDs, stock market investments, real estate or REITs, inflation-protected bonds, and commodities. And of course, don't forget that valuable bonus tip: investing in yourself. I hope you found this video helpful. Let me know in the comments which strategy you'll try first. Don't forget to like, subscribe, and share this video if you want more tips on how to make your money work for you. Thanks for watching, and see you in the next video.